Our first speaker is Holly Jernevoy. She's with Emmanuel Shepherd and Condon Law Firm.
Thank you, Andra. Hi, everyone. All right, I want to give you guys fair warning. I had my paralegal review this presentation just because she's the brains of the operation. I'm just the pretty face that comes in and explains documents. And I had to wake her up 3 times while she read it because taxes are kind of dry. But as you probably already know, taxes based on value are called ad valorem taxes. They are in proportion to the estimated value, I'm quoting here, the estimated value of the goods or transactions. Most city and county taxes fall into this category. These taxes pay for your roads, your schools, your fire services, your street lights, etc. And you have a copy of your tax bill. I left some on the back table. I don't know if they put them on all the tables, but you can see it's got listed. They pay for public schools by local board, by state law, water management, the library, all this kind of stuff. So property taxes, as much as we hate them, they're pretty important to take care of us in our lives. And these property taxes, the process of collecting them is a coordinated effort of the property appraiser who determines the market value of your property. Ad valorem taxes are based on the status of the property January 1st of each tax year. And they send out a notice of proposed property taxes or trim notice that provides your proposed property taxes and assessments, including any exemptions. These trim notices compare the previous year's taxes, the tax amount you will owe under the tentative budget change, and the tax amount you will owe if the taxing authorities do not accept or adopt the budget change. Those trim notices are mailed at the end of the summer. Tax bills arrive the first week in November. If taxes are paid in November, there is a 4% discount. If they're paid in December, 3%, 2% in January, 1% in February. They are due in March, and penalties begin in April. Disability. So if you're a 100% disabled veteran, you are immune from property taxes. There's also the total disability exemption, just if your regular person is totally disabled. There's a medical disability exemption, seniors over 65, and widows and widowers. Then there's the agricultural classification. If you have non-homestead property, there is a 10% cap on how much the taxes can be raised. So non-homestead property cannot be raised by more than 10% per year.
Well, first, before I introduce our next speaker, I would also like to introduce Christina Doss, who's with us this evening from Saltmarsh, Cleveland and Gunn. David, I want to introduce David Uslan. He's a CPA and he's a tax practice leader with Saltmarsh, Cleveland and Gunn.
I just wanted to be able to cover, obviously, that there's sort of, we talked about real estate taxes, which is a property tax, and I'm going to cover sort of the income tax effect of property taxes. So, as everybody knows, they've been able to deduct real estate taxes on their personal income tax return for a long time. So that goes on Schedule A. So your personal income tax, property taxes go on Schedule A. If you pay property taxes on your rental properties that you own and rent to renters, that would be on a Schedule E. And so that's always been a deduction on Schedule A. And you've always been able to deduct all the property taxes of all the properties you've owned personally. So that could be your home, your vacation, a second home, any vacant land that you own, or other investment property that you own around the country. You've been able to deduct those on Schedule A. And so there's been a long history of that. But this year, they had the Tax Cuts and Jobs Act, which had a major impact on all sorts of deductions across the board for both individuals and companies. This year, and starting in 2018, for married filing joint, for instance, they went from $12,700 standard deduction to $24,000. So, and this had a major impact of individuals later in life that had a lot of equity in their home, didn't have a high mortgage and things like that. So it took a lot for them to be able to, a lot of them that used to be able to itemize on their income tax return, they are no longer itemizing. So the real estate taxes that they paid really had no impact on being able to deduct that on their personal income tax return. So it has a pretty big impact on what the benefit of being able to deduct your real estate taxes when a lot of people that used to be able to itemize are no longer itemizing on your tax return. So just remember, when you buy or sell a home in that year, make sure your CPA gets your closing statement. That's very important because it can really change the amount that you can deduct on your income tax return. I did want to touch on a few other things that that affect a lot of individuals this year as far as the Tax Act. The second one that impacts a lot of owners of property is that in the past, you could own a primary residence and a second home and be able to deduct the interest of $1 million of loan. So if you had $1 million of loan between the first residence and the second residence, that expense was deductible. Now, starting in 2018, if you buy a home in 2018 that has, and the combination of those two have more than $750,000 of interest, you can only deduct the interest related to $750,000. So if you bought before you would be able to deduct the interest on the $1 million, now you can only deduct the interest on the $750,000. The good news is that it's grandfathered in, meaning that if you've owned the home and you had $1 million of loan, you can still deduct all the interest on that, all the interest related to that loan if it's still over $1 million if you owned it before 2018. So it's only new purchases where the $750,000 limitation comes into play. Again, if you take out a home equity loan, let's say $100,000, you can only deduct the interest if it's used to substantially improve your property, which means it has to be able to increase the fair market value of your property. So it has to be something like improve your kitchen, improve bathrooms, or something like that. So you have to be able to trace the proceeds of the loan to make sure that you used it to improve your home in some sort of way that increased the value of the property. Put in a pool, you can think of things that would obviously do that, but it has to really substantially improve the fair market value of your property in order to be able to deduct the interest. That area that a lot of people took deductions in is what's called miscellaneous itemized deductions. So that was at the bottom of Schedule A, and what was in those were things like investment fees, tax return preparation fees. The other big one was really unreimbursed employee business expenses. So a lot of people that were employed would pay for things on their own, think teachers, pilots, things like that. They may have had a lot of out-of-pocket expenses that were not covered by their employer, and they would do a Form 2106 and be able to deduct that on Schedule A as a miscellaneous itemized deduction that no longer exists. So if you're finding yourself in an area where you're not being able to get the tax deduction, another way you can benefit is if you have a traditional IRA. When you reach age 70 and a half, you're required to take out what's called a required minimum distribution every year. And you have to include that in your income. And so what you can do, if you don't really need that money, even though you're required to take it out, included income, you can designate and send it straight to a charity. So the charity gets the money. You don't get a deduction, but you also don't include it in income. So the key is you don't include it in income first, and you don't get a deduction, but you get the benefit of not having to include it in income, so you're at the same place. So that's another way if you're in a position where you're getting required minimum distributions every year from your traditional IRA, you can send those directly to a charity. Just to touch on a couple other things is the 529 plan. So a lot of individuals have 529 plans in order to save for college. And now they made it broader. So you can use $10,000 per student to be able to pay for K through 12 private schools, religious schools, and things like that. So it doesn't have to be college. It can be any private school, and it's $10,000 per student, per recipient is the maximum for that. So that's a pretty good benefit. And last, I'd like to touch on something that also sort of snuck under the radar a little bit, is meals and entertainment. So in the past, meals and entertainment, if you have a business and you took out a client for dinner, or you took them to a football game, or you took them golfing or something like that, the deduction was 50% of the of how much you spent. So that was 50% whether it was a meal or whether it was entertainment. So now they said, starting in 2018, meals are still 50%, but entertainment is 0. So think if you took someone to the symphony, or if you take someone golfing, or you take someone on a boating trip or something like that, that you do no longer get a deduction for that. And the other thing, if you have a business, the biggest thing you can do is separate out the cost into 2 categories, because in the past, everything was lumped into something called meals and entertainment in your general ledger. And really, you need to separate that into one line item for meals and one item for entertainment. So you make sure you capture what's really 50% versus 0%. Well, no taxes are permanent, I'd like to say. So, but these individuals, it was set up to go from 2018 through 2025. So whatever the rules were in 2017, go back, and when it gets to 2026, it goes back to what the rules were in 2017. That's assuming nothing else changes. So obviously, if there's new Congress, new president, all that kind of stuff, all that's out the door, and it can certainly change at any time. but right now it's set to sunset after 2025. So all these rules that we're trying to figure out change after 2025. On the corporate side, those changes are permanent, but on the individual side, all these individual changes are through only 2025. So.
Thank you very much, David. I also want to thank our sponsors, Emmanuel Shepherd Condon, Holly Jernevoy, obviously Salt Marsh, Cleveland, and Gunn as well, and Mr. Davids for speaking, and also Glenn Wyndham, who is ill and couldn't be here today. So thank you very much, and again, you guys have something to drink and grab some more food. Appreciate your coming very much.
Hi, I'm Kathy Dredden with the Andrew Morgan team of Top Gun Property Realty. I want to thank you so much for joining our live stream tonight on the property tax seminar. We are always dedicated to adding value to you as a homeowner, an investor, a buyer, or a seller in the greater Pensacola area, and want to make sure you have up-to-date information on all things relevant to real estate. So if you're thinking of selling, buying, or just have questions in general, please just give us a call, text, or email, and we're always happy to be of service. Thanks so much.